talk about the stock of Spirit Airlines because it's becoming a very desirable stock because certain personalities, certain clowns are hyping it online, and they're pushing a lot of traders to buy the dips on Spirit Airline and believe in the story that Spirit Airline is the best airline and will recover, and it's a great investment to buy Spirit Airlines at these levels. Is there any factual information that we can look at financially to give us an indicator that Spirit Airline is a great catch, is a great investment at this point? We'll look at the facts and I'll let you decide for yourself. Spirit Airlines is the value airline where people get crammed like sardines and fly for a cheaper rate because they don't let you have bags or carry-ons. You have to pay exuberant fees to have carry-ons. And most people who use Spirit Airlines are people who hop in a plane with a backpack, and that's it. That's all they need for the destination. So the argument for recovery, and I'll give the crowd, the gambling crowd who are bidding on Spirit Airlines, the benefit of the doubt. They're saying that because of the value element of Spirit Airlines, it is a better investment in the airline industry and will make a quicker comeback than, say, American Airlines or Delta or any of the big old school airlines. And the reason is because the majority of Spirit Airline flights are domestic, and the crowd, the passenger demographic, is highly younger, so they're not at risk group. My counter argument would be, look at the data, look at the unemployment levels. It's hitting younger people and people with lower income who are likely to be customers of Spirit harder. Is Spirit Airlines really healthier financially compared to older airlines like American and Delta and the rest of them? Let's take a look at the facts. Let's take a look at these ratios, very important ratios in the airline industry. The first one is the operating margin. We want to see if Spirit Airlines is it healthy from an operational perspective. And when we look at the operational margin, the most recent one, it's minus 7.5%. Okay, you might say this is a pandemic. Of course, their operating margins are going to trend negative. For the last few years, the trend of their operating margin, and it's trending lower. The operating margin been trending lower even before the pandemic. This is a company that experiencing shrinking operation margin and profits from its operations even before the pandemic. What makes you think that it will start picking up and do better? The only argument you can make is, oh, the stock is too cheap and I'm not expecting it to go back to where it was before. I'm just looking for a quick profit. That's fine, but it doesn't make this company investable right now. Stop telling people that this is a good investment. It's not. It could be a trading opportunity where you could make up to 10, 20, 30, even 50% from bounces, but it's going to be very, very volatile. Take a look at their interest coverage rate. Can they keep up with the debt? Can they pay their interest and their debt and service them with the current operational margins? And when you look at the current interest rate, it's a loss. It's pretty much negative. It's zero. And then you look at their interest coverage historically, the last few years, it's also trending down. This company was all trending already in negative financial wellness way before the pandemic hit. And now all of a sudden, with all the debt that they're taking now, they'll be able to service their interest coverage. They had a debt problem before. What makes you think that more debt will help them out of the hole? It's not. More debt does not compensate for revenue. Let's take a look at the asset test, the quick ratio. Let's see if they can service their, it's a stress test really, if they can service their debt with their current assets minus inventories. They're pretty much at really bad level. When you see the quick ratio at 1, that's bad. But this quick ratio is terrible, meaning that the company already has a debt problem. Is the company utilizing its assets intelligently and making profits from it? Well, we see the current return on investment rate. It's negative 1.5 point. And if you look at the return on investment or return on assets historically the last few years, it's still trending down. Guys, This is a company that's been struggling before the pandemic. It was trending down. It has a lot of negative trends. It wasn't a good investment back then, and it's certainly not a good investment right now. The last argument that I hear is, hey, passengers are coming back. We're going to start to fly again. You know, we fly in this country.
They don't like me. They don't like what I stand for. They don't like you making money. They don't like me making money. They don't like America. They're Al Qaeda, all that. We fly in this country overnight, over and over again. They try to tank us with the airlines. And then we prove that we're too strong. We have an army of traders, and we are buying Spirit, and we get it back on top. And we do this dance. We do the tango. The dance is seduction. I'm fine with it. Let's do it again.
Okay, ask yourself, is this the right way to make investment decisions? Or is it looking at the facts, at the ratios, at balance sheets, and making an intelligible investment decision? I think the answer is clear. Here are the facts. The TSA travel count, when you take this information, you produce a chart, and you look at the chart, there is no V-shaped recovery here. It's actually recovering in a slower than anticipated rate. There are a lot of aspects of the economy that had a V-shaped recovery, at least for now. Airlines are certainly not one of them. People are still terrified of flying. Companies will not fly their employees anymore. The flying business, the airline business, is not what it used to be before. It's going to change forever. The changes are not going to be positive. I'm all for spiritual lifting, but I don't buy Spirit.